The corporate cop has taken a big stick to small players over rogue financial planners. Dover Financial lost its licence to operate after damning revelations at the Royal Commission. But critics say ASIC should be taking on the wealth management giants. AMP has also faced serious allegations at the Commission, and its licence should also be on the line. Here's Andrew Robertson.
Just weeks after Dover Financial's boss collapsed at the Banking Royal Commission, the badly behaving company was out of business, bowing to pressure from ASIC to surrender its licence. But despite their own laundry list of wrongdoing, the licences of the Big Four and AMP, it seems, are safe.
Well, I see no reason why it should differentiate between large and small players. If companies or their related planners have transgressed, then they should all be treated the same way.
It was a series of scandals facing the Commonwealth Bank that forced the government to cave in and hold the Royal Commission. The money laundering debacle, for which it will pay a $700 million fine, was the final straw. It followed shocking revelations in CBA's financial planning and insurance divisions and its involvement in the collapsed Storm Financial, all of which cost thousands of people their life savings. And now, according to the Royal Commission, they're the gold medalist in charging fees for no service.
For the individual involved, the upside is that they get, hundreds of thousands of dollars in bonuses, if not millions of dollars in bonuses, is the upside if they manage to get away with it. But the downside is they get fired and their company pays a huge fine. That sounds like a pretty decent trade-off for the individuals involved.
The Royal Commission has recommended criminal charges against AMP for also charging clients but not providing any service, as well as repeatedly lying about it to ASIC. A so-called independent report into the issue was changed 25 times at AMP's insistence. Damien says a surefire way to clean up the industry is for a big company like AMP to lose its licence.
If a large company lost a financial services licence over one of these, that the behaviour for the rest of the companies in the sector would be, for the next generation or two would be fixed.
Banking analyst Brett Lemessurier says the financial system would easily cope with the loss of AMP. However, he says ASIC would have to be careful if it went after the licence of the Commonwealth Bank.
If Commonwealth Bank lost its banking licence, it would have a very significant impact, because obviously it funds much of the Australian community. But if the loss of licence purely related to the financial planning network, well, there's many other homes for those financial planners to go to.
Commonwealth is joining NAB and ANZ in distancing itself from wealth management. It's forming a new separately listed company which will house two of its financial planning businesses as well as its wealth management arm. But after all the scandals, will customers be better off?
I don't think it's intended to be for the customers. It's more for the bank in terms of trying to draw a line under all the scandals and the bad news and the brand damage by separating themselves from the businesses or some of the businesses that have caused most of that.
At the heart of CBA's scandals is the vertical integration model, where financial planners are used as salespeople for the bank's products like superannuation and insurance. The new hived-off company retains that vertical integration.
They will still be owned by a fund manager, and the fund managers live or die by their inflows. So the pressure will be on those financial planners as salesmen to keep those inflows up.
A reason why some believe without a much tougher approach from ASIC, like taking the licence of a big player, we'll be having another Banking Royal Commission in about 10 years.